Started. Welcome, everyone, and thank you for joining Investor Relations Done Right, Lessons Pre to Post Close. My name is Nick Stewart, and I'm the Institutional Investor Relations Lead here at AngelList. For anyone unfamiliar with AngelList, we provide venture firms with tech-enabled back-office support from fund formation to ongoing fund management and distributions. We support over 170 billion in assets on platform with a network of over 70,000 investors. Before I introduce our guest for today, I want to cover two quick housekeeping items. First, our speaker has graciously offered their time to participate in a live Q&A after. So we encourage you to submit your questions in the Q&A chat box below at any time. Second, this conversation is being recorded, so we'll be sure to share it with all of you following the call. And with that, let's move on to our guest speaker, Vienna. We'll wait for Vienna to jump in. Awesome. Can you hear me all right, Vienna?
Yes, coming through just fine. Hi, everyone.
Awesome. Well, I'm very excited to be joined today by Vienna Poiesz, Director of Investor Relations at Strut Consulting. So Strut Consulting is a trusted partner to leading venture capital firms, providing expertise and execution needed to thrive at every stage. Since 2016, Strut has helped funds around the world, from first-time managers to multi-billion-dollar firms, build strong operational foundations, streamline finance and investor relations, and scale sustainably. Their team believes that great operations are a fund's true competitive advantage, allowing managers to focus on what they do best, which is backing the founders who will help shape the future. Vienna, thanks so much for joining. I'll pass it over to you to give a quick introduction for yourself.
Great. Thank you, Nick. Yeah, a bit on my background. I've been in investor relations and fundraising within the VC/PE space for about a decade now. I started my career at Energy Impact Partners. I joined them originally when they had about 50 million in AUM and helped them scale over 2 billion. And that was across 8 different vehicles over 5 years. So there was a lot of activity, and I learned a lot about bringing vehicles to market. I then pivoted over to an emerging manager, Data Community Fund. It was just the GP and I. We were obviously targeting very different types of investors, so high net worth individuals, family offices. We successfully oversubscribed that fund as well. While I was there, I realized that if I wanted to focus my career only on IR and fundraising, it would make more sense if I went into consulting and help a bunch of funds at a time. And so that's when I joined Strut. I've been there for about 3 years now. I'm the head of IR and fundraising. And yeah, that's where I sit today.
Fantastic. Thanks so much. Well, excited to learn more from you, and we can jump right in to some questions. So
Great, let's do it.
to kick it off with the basics, investor relations can mean a lot of different things depending on who you ask. For some, it's updates and reporting. For others, it's about building more genuine relationships. You've seen both sides across multiple firms. So how would you define investor relations, both in and outside of the fundraising process?
Yeah, I mean, I think IR generally is the discipline of trust building over time. And there's certainly, systems that we add to that. There's consistent communication, and that kind of supports IR. But that's kind of what it means to me, trust building over time. Within fundraising periods, IR really seeks to help LPs underwrite the strategy and the people in the platform supporting that strategy. At least ideally, that's what it should be doing. And so that consists of a strong story, how responsive and organized the process is, and also demonstrating institutional readiness. So think materials, data room, follow-up, that kind of a thing. And IR is really about process management, credibility, and momentum in fundraising. So I think a lot of times folks think just about outreach, and it's certainly a lot more than that. When you're not fundraising, it's about relationship management and stewardship. So in order to do that well, I would say it's about setting expectations early. So letting LPs know sort of what communication is going to look like and ensuring that that's kind of consistent throughout the relationship. It's also about creating confidence that you're deploying capital thoughtfully, even when performance is down, right? You need to keep that confidence. And so, how do you do that? The mechanisms of it are yes, reporting, it's proactive communication. It's accessibility of the GPs too. You want to make sure that you're actually available. Um, and it's a bit of an art of like knowing when to engage LPs directly versus letting the information speak for itself. So regardless of whether you're fundraising or not, if you're doing IR well, you're reducing friction. That's really the point. And so when you're raising, that means you're helping an LP say yes easily. And when you're not, you're helping an LP stay supportive and confident in your abilities over the lifetime of the fund. So at its core, it's not a function that you turn on and off. It's got to be there all the time. It's an ongoing operating discipline that compounds over time, similarly to returns or anything else.
I like that. Yeah, consistently reducing friction and building trust, super important. So let's move on to the beginning of that life cycle. So where investor relations begins before the first pitch deck even goes out. This
Hmm.
pre-fundraising phase can make or break the entire process, but it's often overlooked or rushed. How long should the pre-fundraising phase be, in your opinion? And how do you distinguish that work from the more general marketing or brand building efforts that get done?
Yeah, I think it depends on whether you're an emerging manager or an established fund. So if you're an emerging manager, I would recommend 6 to 12 months. If you're an established fund, then I would say 3 to 6. And so, like, what are you doing throughout this time? Like, I understand that that's a long period of time to engage folks, but you really need to be pressure testing your strategy, right? You need to be refining your positioning, understanding the competitive landscape and like where you sit within that. Um, Building a credible and qualified LP pipeline is also very important because you don't want to like actually go to market and then you realize like, oh shit, I just built a pipeline of LPs that will never invest in a first time fund, for example. And so that's really important. You should also be learning as you're sort of communicating what your ideas are, like where is the pushback going to be, right? These folks that you're engaging and getting feedback from, what questions are they asking, and are they asking them consistently? Because then you should be prepared to answer those or to solve for them, right? You in the pre-fundraising period, you have time to solve for it. If you're already fundraising, it may just lead to a no, right? And that's kind of the benefit of this period. And then also, right, your team, you can make sure that they can clearly and confidently articulate who they are, why you win, and why this fund is different from others. So that's obviously also always an important piece is the actual pitching. Um, And in terms of like how is pre-marketing different from general marketing and branding, I would say pre-marketing is not about promotion. Um, it's about preparation. So it's an inward looking exercise, and you're only engaging highly targeted contacts. Marketing and branding, it's outward facing, it's broad, and you're doing it to increase visibility. So the goal is completely different, or at least it should be. Um, and ultimately, what I find with my clients is like when you rush the pre-marketing phase, or you skip it, certainly there are folks that skip it too. What happens is the fundraising period becomes reactive. And what that looks like is we're rewriting pitch decks mid-raise, right? We're pivoting, which doesn't look good. We're scrambling to answer diligence questions because they should have been anticipated, but they weren't. Um, And we can realize too late that the pipeline, as I mentioned earlier, is like not aligned with the strategy. And those are difficult things to solve for mid-raise. So if you're doing pre-marketing correctly, your raise should be a lot smoother. You should be more confident doing it, and it should be more efficient. So I think like pre-fundraising is essentially the difference between testing your strategy privately and defending it publicly. And that latter piece is like not a great position to be in. So that's kind of why it's that important.
Right, right. There's nothing worse than being at the finish line and then they follow up with questions that should have been covered, weeks or months before. So
I mean,
super helpful.
100%. Yes.
I guess two follow-ups on that. One, for prospects that are now warm, what are some of the best strategies you've found to that GPs can use to nurture those warm leads and keep them engaged throughout the race till it's time to reach the finish line? And two, you kind
Hmm.
of touched on this. I'd love to hear about sort of the concerns with reaching out too abruptly to too large of a pipeline and whether that sort of cuts out those investors from potentially ever becoming warm leads if approached wrong.
Yeah. 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 I mean, that is like so important that like an effective GP is going to treat the fundraise like a managed process, right? And not a series of pitches. And so I think that distinction is really important. And part of that is going to be segmentation and prioritization. And understanding at the very beginning that not every LP is of equal priority is going to help you avoid burnout. And it's also going to stop you from creating too much noise. A lot of times I'll like enter a client's CRM and there's like 1,000 opportunities and they all sort of just sit in no real prioritization. And what happens is the team is totally overwhelmed. They don't know where to spend their time. And so it is really important for the GP to understand who moves slowly, who is never going to come in at a first close, um, who writes small checks versus large. You got to prioritize large checks. That's just an inevitability. Um, and like also just the way that they want to be contacted. So some LPs will like this just happened the other day. I thought it was so great with a client. I'm working with this client and he knows this LP really well. And he was like, he never responds unless I'm in the area. And so he was like, so what I'm going to do is I'm going to drive 8 hours and post up at a cafe nearby and be like, oh, hey, whatever his name is, let's just say Jim, I'm in the area. Right. And that's the only way that he responds. So instead of like, you know, emailing him 30 times, he understands this person well enough to like know how to get through the door. So I think that those pieces are really helpful: segmentation, prioritization, and knowing the LPs. And then also like creating a predictable cadence of touch points. This is important to think about before you ever start the raise. Like not just constant check-ins. Like we want useful updates, not just annoying ones. And I say that also not at all coming at GPs. I think that GPs a lot of times hit burnout because they feel annoying. And so one of the ways to avoid that is like you need to be thinking about your pipeline. When are you going to be able to announce new investments? When are you going to have portfolio updates? I understand that's not all like we can't just predict when all of those things are going to happen. And I have some clients, they have portfolios of 500 companies. That rocks because we always have an update. Like, and I understand that that is like not the case for all GPs. But like, think of it about it in advance, right? New investment portfolio updates. You can close milestones, events that you're going to be at where you can like easily connect with the LP, stuff you could also update the data room, right? But only update them if there's one, a significant change, or two, like you are directly addressing some of their concerns or questions, right? Because again, we don't just want to like follow up with nothing. So thinking about that is another piece. And then I would say the third thing that makes a GP really effective is managing diligence proactively. So one, don't be afraid to ask an LP, what is your process? What are the steps? How long does that take? Right? Like get familiar with what their process looks like. And then like help them manage that. And so this will make an LP like be able to move faster, but they'll also be engaged longer. And yeah, and I guess also like coming back to the anticipating the questions piece, you should know what your gaps are. And so answer those questions in your data room, in your deck, like just make it really easy to answer, like for an LP to be like, oh, okay, like this is their argument for that, or this fills that gap, right? Give them those answers and make that simple. Yeah, I think that that's always really effective as well.
That's all super valuable. And yeah, it's funny. I wonder how much of the venture ecosystem is a bunch of people pretending to all organically be in the area. It's maybe a lot.
I know. Well, okay, so I thought that, but actually I don't think so. I've worked with about 40 clients since joining Strut, and it was the first time I heard that they were like, of course you go to conferences because you hope to run into someone, but that you truly are driving 8 hours to just like be there and be available. I was like, damn, that is commitment.
That's what it takes.
Yeah,
But great,
totally.
great. So, moving further beyond the pipeline, as those relationships progress, timing certainly becomes everything. So when an LP is actually ready to commit, the handoff from that initial interest to finishing diligence to action can be, seamless or full of friction. So I'm curious, when an
Yeah.
LP is ready for that next step, how have you seen the strongest managers make that conversion as quick and easy as possible?
Yeah. So accepting a commitment should never be the holdup. Like, it really should be like an operational handoff, not an improv session, right? Your LP, your first commitment should never be like you trying to figure it out. And so I really recommend that you have this in place before you get anywhere near this point. But things to think about are like, um, there needs to be clear steps in the process. There needs to be people responsible for all of those different steps. And like at Strut, we help our clients also in terms of like we'll even create email templates in advance, right? Like what does it look like to accept a commitment, to confirm a commitment, to send the docs, and then for the close, and then for the capital call, right? All of this is like planned out. And with AngelList, you guys make this generally pretty easy. You have a lot of the different service providers all in one. And so that makes it easier to navigate. But for folks who don't, it's like you've got a GP accepting a commitment. You've got an IR lead who has to manage the closing tool in theory. Maybe your legal is doing it. You've got a legal team who needs to review and sign off. You've got a KYC and AML provider who has to review. Then you have to initiate the close. Then the GP has to alert the LPs. And then the fund admin has to set up the portal and do the actual capital call, right? So it's a lot of moving pieces. And so a way that we tend to get ahead of this is by creating a closing process document and everyone has to review and sign off so that they like know their responsibility. We also create an externally facing one that we provide to LPs so that they're aware of what to expect from their point of view. They obviously don't need to know everything that's going on in the background. But that way they know sort of the emails they should be receiving, the timing, the capital call date, the amount, stuff like that. Um, but yeah, again, make it just super operational, get ahead of that process and like don't lose an LP at this stage when they've already said yes,
Right,
that
right.
would be a real shame.
Yeah, like it's confusing enough, but you absolutely should act like you've been there before. It should not be like you also don't understand. If anything, the LP has some learning to do, and that's okay. But Someone
Yeah,
has to feel like they're the pilot of the ship, sort of guiding the process.
totally.
Yeah. And so maybe this is related, but maybe there's another example you have. I'm curious what parts of the fundraising process you see that tend to break down the quickest or the worst without proper IR support in place. Would you say it's that closing, or would you say it's other parts of the fundraising process?
The closing is would be a piece of it. I think consistency is likely going to be the first thing. So what often happens is like uneven, sort of like sporadic communications, where I think a GP will get distracted from fundraising because they've got a deal to do, because they have a whole bunch of other things to
Right.
do. And then, so they'll kind of like disappear from an LP's radar for a couple of months. And then all of a sudden, they're like way too available, right? They'll like send through updates, they'll ask to meet, and it'll all be sort of like within the same week. So uh, that, from the LP's perspective, can feel disorganized. It can also feel like a lack of priority. It can feel like you kind of forgot about them. Maybe something fell through and now you're coming back to me. It's just not a great experience. And so, yeah, I think consistency is kind of the first thing that can fall apart or be looked over. Um, I do think that, and this touches on the close piece, process discipline is definitely a part of it. So it's also like materials getting updated mid-raise, or sort of like finding inconsistencies throughout the data room and the different materials. That happens a lot. And that can sort of raise red flags for LPs, right? Because if your portfolio, like if your fund model says one thing, but then the portfolio construction slide in your pitch deck says another thing, that's alarming. And so that certainly happens a lot. I also think momentum is a big piece. So if there's no one tracking the different stages and what's been sent, what's not been sent, and follow up on decision timelines. So if an LP is like, hey, I can't give you an answer till January, you better be reaching out in January. But a lot of times that'll fall through the cracks. So I see that quite a bit. And then maybe expectations setting slips is another one where it's like, a GP will communicate a close date. Let's say it's December 20th. Don't pick that close date. That's not great with the holidays. So that's not advice. But let's say
Yeah.
it is, and then it slips because of the holidays. That could have been avoided, but okay. Um, then uh, like making sure to follow up and let LPs know that that often falls through the cracks too. And so then like the close is moving, LPs are unaware of that. The capital call timing is really vague, right? Like things like that kind of fall through the cracks. Um, and it really doesn't mean that the manager is weak. It just means that they're like constrained in their capacity, which makes a lot of sense. And so a good IR lead would provide structure and accountability needed to keep the process really credible.
Yeah, makes sense. And making sure all those touch points are valuable. Like I feel like even the cadence and the operational discipline are so intertwined, to avoid giving
Hmm.
LPs instructions or guidance and you blast it out to every single prospect at once, only to
Yeah.
realize you're missing a ton of pieces that would have been super useful to
Yeah.
touch on in the initial note.
Yep.
Better to have those follow-ups be
Absolutely.
updates rather than corrections in a lot of cases,
Yep.
I would say.
Yep. Absolutely.
That's all great. Let's flip perspectives for a minute and look at this from an LP's point of view. So understanding how investors evaluate GPs, especially emerging ones, can completely change how you approach outreach and general relationship building. What would you say LPs are really evaluating when they invest in a GP for the first time?
Yeah. So I think LPs are often underwriting far more than like a single fund or a near-term return profile. They're generally looking at people like judgment and durability as well. Like, can they consistently deploy capital into this firm is definitely something they'll be thinking about. I think, yeah, there's a difference between like with emerging managers. performance is going to matter, but the data's limited. You might have one fund, max two fund. At least emerging manager for me is up to fund three. And then or your track record is fully from prior platforms, right? So that's a little bit difficult to assess. And so they're really looking for how does a GP think? How are the decisions made within this firm? How do you assess risks and avoid them? And does your story hold up under pressure? Those are really going to be the concerns and where they're kind of trying to poke holes and see if that's the case. There's also just like the platform quality that they're going to look at. So, governance, operations, compliance, investor communications. So that'll all be of interest and a concern for them, where it's like, can you responsibly manage capital over time? Right. And I think sometimes GPs will focus too much on like, we can source good deals. And like, that's great in the beginning, but like, there's the initial investments, then there's the follow on, and then there's the portfolio management and your ability to actually return capital to the LPs. And so being able to show like that you are going to be a good steward for the full cycle is definitely important. Um, and then also in terms of like, I think self-awareness is really important, where you, even if you're a solo GP, right? You are not good at everything. You are not good at everything that your fund will do. And so knowing that and being ready, prepared to rely on others to fill those gaps is super important, whether it's like with advisors or service providers, partners of some kind. Of course, your team is an obvious place. Um, but yeah, I think overconfidence can sometimes be a red flag too. So the fund matters, but the manager is kind of what matters most, especially when we're dealing with an emerging manager.
Yeah, and I agree. I think communicating, some of your weak points proactively in the right light is a lot better than it
Yeah,
being a gotcha situation because it's like, yes,
yeah,
I don't have this, I haven't done this, I've evaluated the trade-offs, and here's why I made that decision, rather than this looking like
yeah,
I just never contemplated it.
yeah,
Seems a lot
exactly.
more useful. So that's really
Yeah.
helpful. And my obvious follow-up is going to be, now moving on, the difference between a fund one versus like a fund three commitment and how that LP's lens of subscribing and underwriting might change.
Yeah. Yeah. I think um, with a fund one, you're underwriting potential. And so you're willing to take, or the LP needs to be willing to take an execution risk for, whatever it might be, differentiated access, emerging talent, some hyper unique strategy. But yeah, again, their focus is going to be on team background. It's the decision making framework. It's a sourcing advantage, and of course, ideally, there are some kinds of early signals that this strategy is going to work, right? I mean, that kind of needs to be there. And then as we get to like a fund three, um, they're no longer underwriting a concept. They're underwriting consistency, scalability. There's real data there we can start to dig into. And so I think one of those things is disciplined portfolio construction, which a lot of GPs move away from. And especially if you have an LP through all those different funds, they are able to look at what you said you would do and what you did.
Right.
Um, and I find that a lot of GPs, once they launch the fund, cease to track the construction that they said they would do. And, that can happen sometimes because there's like a really great opportunity in front of them. Maybe they're feeling a bit impulsive or like, or they don't have someone tracking that. And so it's not front of mind. But that's definitely something that LPs are going to be looking at. Um, I think the other thing they're looking for is like, is your success driven by consistency of picking not just one-off wins or advantageous market conditions, right? Are you actually doing something that can be recreated again and again in future funds? So that's something as well. You know, if you have one random unicorn, that's really great, and maybe you return the fund a couple times over with that unicorn. But you want to make it look, you know, intentional and like it can be replicated. And so then there's operational expectations that certainly changes when you get to that point. So that's going to be kind of, you know, reporting, formalizing governance, clearly defined internal roles. And, you know, I mean, really, you're just kind of taking informal processes and you're formalizing those. And then also, you know, I think the heavy reliance on one person ceases to be acceptable as
Yeah.
well. And so that's where you start getting into succession planning, key person clause, um, yeah, and that kind of thing. So, yeah, it's really moving from can this team do what they say they're going to do to can they do it repeatedly through cycles and at scale?
Yeah, and we can touch on this in a follow-up I have later, but you know, it all comes down to things you could have proactively communicated if your strategy did shift as well, especially on like the portfolio construction side. Like, do they want to find out in two and a
Totally.
half years that you haven't been doing what you said you would, or hey,
Yeah.
I very upfront about changing this, and
Yeah.
then no. But we can touch on that more. I first want to pivot a little bit to more strategy and structure, as you were talking about.
Hmm.
So you know, the most effective IR programs aren't just about relationships, but you know, the systems and foundation you're building for how everything will work. What systems or processes should be in place by the time of first close, if we're talking about a fund?
Hmm.
I know there are things you just talked
Hmm.
about where by fund three it should be well oiled, but like first close, what's table stakes?
Yeah. Yeah. Service providers should be in place. So that's going to include all the ones I mentioned before, legal, KYC, fund admin. But also tax, audit, right? LPs care about this and they want to know that you've thought about it and that you already have a partnership in place. And then maybe compliance, depending on how much you're raising.
Yeah.
But generally speaking, for a first time fund, that wouldn't be something I recommend. CRM needs to be in place. I would be shocked if you got to a first close without one. It does happen. I have one client who's raising 100 million from two LPs. Okay, he doesn't need a CRM. I'm not going to push a CRM on him. He'll probably need one when he starts investing, but yeah, then there's not too much to track. He knows where the capital's coming from. He's okay with the capital concentration. Fine. But yes, a CRM, very important to track those relationships from the beginning for this raise, but also future raises. Your data room, obviously, so wherever you are hosting that, you will need it. A closing tool is going to be necessary. So some folks are going to be using like Vanilla through their legal. So if you're with Cooley, you're probably using Vanilla. Others will be using a pass-through, or you might have a fund admin like an Angel List or a Carta who are able to, you know, basically host that service for you. And so that's also possible, but you need something in place there, and you also need to know how to use it. Um, and I would also say, always test it before you launch it. It's very important to try and catch the issues that might be there. For example, I had a client where, you know, they we were sending out all these docs and the joint investor, like when you clicked entity type joint
Yeah.
investor, was not sending it to the joint, the other joint. And so it turned out that all these docs had not been signed by both parties. And it's not the end of the world. It just means you have to contact that LP, let them know something went wrong, and get the signature. It's administratively burdensome and just annoying. So just flagging that, always test it. And then you're going to need a fund admin portal, right, for the reporting, for the capital call, things like that. So it can be pretty bare bones. I'm not going to tell you to build out everything from day one, but those are kind of the things that you really do need in place for the close.
Yeah, yeah, and even with the bare bones table stake stuff set up, what do you think are the quickest things that you see GPs lose efficiency with or start making mistakes with LP management, like as soon as you know that close is kicked off?
Yeah, I will say. So the biggest efficiency losses are going to be in the way that the GP structures the CRM and uses it. That's where I
Mhm.
see it most often across our clients. So, your LP management should primarily live there so that you can see like when you last contacted them, what stage they're at, things like that. And so the most common mistake I see is that the status of a CRM is overloaded with meaning. And what I mean by that is like a status should just track steps in the process. That's the only thing it does. It does not track timing. It does not track probability. It only tracks one thing. And when you overload fields with meaning, they start to become useless. You can no longer analyze your data because one field is actually tracking three things. And so understanding that from the beginning will really help, especially when you start getting to like 500 opportunities, because you won't be able to analyze your data. You won't be able to map out the funnel, understand where you should be focusing time. It just becomes kind of a mess, basically, a little bit of a nightmare. Um, and then I would say outside of that, like, making sure that you are creating views within your CRM that really like immediately let you know what relationships are getting cold and who you need to be speaking to, right? Because if your CRM's not doing that, it's also not doing what it's supposed to.
Right.
And a lot of times, what I'll see with clients, and I think this is a really quick way to know if your CRM is working for you or not. If you are exporting the data into an Excel to analyze, to have a team meeting and review, if you are doing that, your CRM is set up incorrectly.
Right.
Yeah. Because it means that when you log on, you're not able to get the view that you need. And so you have to manipulate the data in Excel because you've set it up wrong. Yeah.
Yeah.
So
Yeah.
that's a quick way to know.
Yeah. Let me change all the data so it makes sense to the rest of my team because in my head I
Yeah.
understand it. But yeah. Yeah.
Yeah,
Okay.
exactly.
Makes sense. All right, I'll pivot a little bit more. I want to talk about what great IR ultimately it leads to. So long-term partnerships. The strongest managers turn their LPs into advocates who come back fund after fund, like you talked about. Can you share examples where GPs successfully made that conversion of turning a single LP into a long-term anchor partner across funds, and what types of strategies made that effective in driving re-ups?
Yeah. I think the strongest GP LP relationships that I've seen are when the GP genuinely brings the LP into the fold. And by that, I mean like, yes, they like seek their perspective on major decisions.
Mhm.
But I also mean like not just formally through an LPAC, informally as well can make them feel special, but also like more in the team kind of. Have them be a thought partner, right? Ask for their input, pressure test ideas, new funds, things like that. Um, and show them how their point of view is impacting the choices that you're making and how the fund is actually operating. Um, and so, like, some of the ways, like, tangibly that you can do that is like with anchor LPs, ask them like what kind of reporting they need to do their internal reporting and have your reporting align with that. Make their job easy. Show them that you're really doing the work to like, again, like take in their perspective and their wants. Um, Meetings and events, right? Whether it's the AGM or something more informal, design it to be useful to them. That's like that. Well, one, they'll show up more, but also like again, if you pull them in for the agenda and stuff, they feel ownership in the fund. Um, and so you can also kind of have them, give input on, I don't know, portfolio construction or risk management, kind of up to you, but the more engagement is probably better. And essentially they cease to feel like capital providers and they start to actually feel like partners. And I would say, as an example of who I've seen do that best, I mean, that was probably at Energy Impact Partners. It was incredibly impressive. They had core anchor investors, including Excel and Southern Company, that they really went above and beyond. They created vehicles tailored to their wants. They, focused full research teams on the areas that those LPs cared about. They pushed for certain investments. And what I would say is like there's a balance to be had here. You do want your fund to be your own. Um, and some would argue maybe they went too far, but they also, these LPs are likely to recommit for the rest of time. I think that they see EIP as their internal CVC arm, and the EIP does not exist without them. And so
Right.
they feel so pulled in that even like performance would not push them away. Like there would really have to be something catastrophic to happen to push them out. And they also have become such a great resource for them to bring in more LPs.
That's great. That's yeah, fantastic. Okay, I'm gonna do one more rapid fire before we do Q&A, just as we're running on
Yeah,
time. Um,
yeah, let's do it.
what's the biggest myth you hear about LP communication that you'd love to debunk once and for all?
Yeah, I think um, there's this idea of like what's too much transparency and like when do you go too far in letting an LP in? And I think that there is no such thing as too much transparency when it comes to facts. What I do think there is too much unstructured or uncontextualized information that is shared. And when that happens, yes, it can definitely backfire. You want to be in control of the narrative that you are sharing. You do not want to be reactive. You want to come across as confident. But ultimately, if there are facts that need to be known, and they're important, then they do need to be shared because otherwise you're risking trust. And if you break the trust with your LPs, it is incredibly hard to get that back. And usually it actually just means that you lose the LP. So that's probably the myth I would debunk.
Very helpful. Awesome. Well, your questions have been fantastic so far. And we only have time for a few more submitted questions. So I guess first, before doing that and diving in, we're going to have a poll pop up on everyone's screen where you can let us know if you're interested in learning more about AngelList fund offerings. If you check it off, we'll be sure to reach out. But with that, on to the questions. We have one submitted here. What are the most common and biggest mistakes in writing investor updates?
Yeah. Well, actually, what I was just saying is actually
Kind
what
of the
one
same.
piece
Good or
is.
bad news, to be honest.
Yeah,
Yeah.
is one of the pieces is like really think about how you're framing things, right? And also ask, is an LP update the right way to communicate this information? Also, is it the first thing that an LP wants to wake up to, and what they're reading, is it giving them enough context to not freak out and think that their capital is at risk or what have you? And so yeah, really thinking about the framing, what's included there and what shouldn't be. And again, like sort of analyzing what ultimately what's actually important that's going on, and only surfacing those things, right? Because there is also a financial report that's coming
Yeah.
that sort of summarizes the overall SOI, and things like that. So really think through what's worth bringing up.
Yeah, and I guess on that piece, I actually do hear from a lot of managers that, their SOI is still in preparation, but they want to communicate this interim update to prospects or existing LPs.
Mm.
Are there any standards you see on doing that or like big don't do's?
Well, for existing LPs, I do try and pair the LP update with the financials. I
Yeah.
understand that some GPs have, their LPA says 60 days, and that feels long
Yeah.
after quarter end. And that feels long to them, and they want to do something in the interim. But what I found is that if you send the update without the financials, it leads to a lot more questions of
Yeah.
where are the financials?
Yeah.
And so that we usually do try and pair them. And I would stick to that. For prospective LPs, on the other hand, if I would be careful. You need to be conservative. You shouldn't announce something before it has happened. But just because it's not out in your financials yet, if you want to share, for example, an exit, and not speak to the, exact, I don't know, like fund DPI because you don't know that yet, but you can speak to the actual deal metrics, you can send that, LP update email to a prospective LP and let them know. There's
Yeah.
there's no issue with that.
And so safe to say if a prospective LP asks for your latest SOI, they're not talking about things that are in flight that you really want to share. They're asking for the most recent gap one, you'd say.
Oh yeah, yeah. If they're actually asking for the
Yeah.
SOI, then it's usually going to be the
Yeah.
financials. It depends though. I mean, a lot of our clients, like we have one folder that is, it'll all be under portfolio for the data room. And we'll have the actual financials, but
Yeah.
some GPs want a more interactive and consumable SOI.
Hmm.
And that's totally fine. They use Airtable for that. They want to write
Hmm.
a description of each company, they want to write how they sourced it. And a bunch of things that isn't in their formal SOI. And
Right.
that's totally great. Like, provide that. It gives them more information and more context.
Hmm. Awesome.
You just
Uh,
don't want, like, an SOI that says something different from your
right.
other SOI, right? We
Exactly.
want
You're
to
not
keep
making.
consistent.
Yes,
Yes.
absolutely. I like this one. Are there any patterns you've seen with successful cold outreach to LPs among your client base?
Ugh. Cold outreach is so hard. I think like if you're pulling down like PitchBook or Preqin or what have you, contact information, half of those will be bounce backs. Like, and it's I would say the response rate is like 2%, maybe.
Yeah.
And so what I would suggest is like really focus on the warm intros. It's much better to put the effort in. Look on LinkedIn. How can you get connected to this person that you're interested in? Can you ask someone in between to make the introduction? That is going to be way more worthwhile, and you're going to have a higher percentage rate of responses than doing cold outreach.
So basically, if you feel like you have to do massive cold outreach, you probably should just reevaluate your pipeline, make it smaller, and make it at least a little bit more curated to the extent that you can.
Yeah, much more intentional. Yep, exactly.
Okay. And another one, how are you seeing firms use AI to drive efficiency in investor relations? Either, I guess, at any stage, I'm curious.
Yeah. So a few different, well, one, email writing, y'all. Like, I mean, that's a big piece is like, if you need email templates for a certain stage, like any kind of writing, AI is and ChatGPT or whatever you want to use, but it works really well. I do recommend personalizing. Get away from those constant like long lines that ChatGPT adds in. We don't want it to look
The M dash.
AI.
Yeah.
Yeah, the M dash, exactly. So yeah, I mean, keep that in mind. But of course, writing it does a really, really great job. So highly recommend that. And then I think, some of the CRMs these days, they add in a tool into, any meeting that you're having and can auto-populate a lot of your fields. So I think that that's something that's super helpful. You can also query them within the CRM to find like what are my high potential LPs, and it's just like pulling from your conversation. So it'll give you a lot of insights with you not having to do too much digging. Um, So yeah, that's another piece. And then lastly, DDQs is another one. I use Anara for this, ANARA. They do not pay me to say that. But this is a document up. You have probably noticed with ChatGPT when you're like, oh, here's my 90-page LPA, and then you ask it a question, it cannot answer this
Yeah, pretty
question.
fun.
It's insane. And so if you upload it to Anara, all of your documents, I recommend LPAs, side letters, investment documents. You can query those, and it will not only answer it usually accurately, but also cite it. So you can click it, and it automatically pulls the page up in your LPA that says, yes, here's where it is. So you can verify that it's true. So yeah, that's another one that we use pretty frequently.
Really helpful. All right, I think we have time for one more. So I'm going to do this one. What are best practices for re-engaging Fund 1 LPs in a way that reinforces trust, demonstrates learning, and positions Fund 2 as a natural evolution rather than a new pitch?
Hard to know without the details.
Fair.
But I generally speaking, the way that we go about this is we say, here's what we said we would do. Here's how we've done that. If we had had more capital, I'm going to assume that your fund two is going to be larger than your fund one. If we had had more capital, we would have invested more in these companies, and here is what it would have meant for our return profile. Or we didn't get to participate in these deals because they were just far too large, or what have you. I
Mhm.
think sort of showing how you're going to, in concrete terms, how you're going to deploy the additional amount of capital and having those opportunities, showing that you did have them, you had the founders were willing to give you that space within the cap table, but you just weren't able to fulfill it because you didn't have the capital is a really good way of doing that. You know, showing that
Yeah,
you can get those allocations.
right. And ideally, when it's re-engaging, it's not dusting off a relationship you haven't touched on for, a very long time. But if you've been keeping up that
Oh,
cadence, I feel like it's a lot more helpful too.
absolutely. Yeah. I mean, ideally, you there has not been more than like
And an
3 months
engagement.
that have
Yeah.
gone by at any point in time that you haven't spoken to an LP. If you're truly resurfacing after a few years, I mean, I think you kind of need to reassess your IR program and then maybe speak to that with the LP of that being the next evolution of the fund is how you're going to go about the IR program differently next
Yeah.
time.
Yeah. Totally. Totally. Well, thank you so much. With that, we're just about at time. So I'm actually going to have another poll pop up one more time. If you're interested in hearing about AngelList fund offerings, we'll be sure to reach out. And once again, thank you, Vienna, so much for joining us. To learn more about Strut Consulting, you can visit strutconsulting.com. And a big thank you to everyone who turned up today. We appreciate you taking the time and sharing some questions. So had a great conversation today and I really appreciate it.
Yeah, thank you so much. And thank you all for coming.
All right, awesome. Take care, Vienna.
Bye.